Investors don't like tariffs. Tariffs make business cumbersome, they make it more expensive. And that is showing now in the numbers that we're seeing today, with the markets down, like you described, in some cases more than 4%. And that is something, especially for retail investors like you and I, when we wake up tomorrow morning and we check our portfolio, we're going to see a number that can sometimes make us feel really uneasy that we've lost X amount of dollars in just one day.
Right. And that's where this kind of hits really the vast majority of people, right? Tell me, what is going to be the impact on the general public because of this?
Well, there's a few things that happen during these types of market volatile times. One is people who are uncertain about where the markets are headed sometimes get scared and get out of the market. So, for example, if you have a $100,000 portfolio and it follows the performance of the S&P 500, which is a very popular way for many everyday investors to invest, you would wake up tomorrow morning. Markets still have 45 minutes before they close, but more than likely you'll wake up tomorrow morning and your portfolio will be down $4,500, $5,000. And for some people, that's too much to handle. That's just too much of a stomach drop for them, and they sell and they get out of the market and they decide, I'll get back in when things get a little bit smoother. And most history has shown us that in most cases, that's not the right way to manage your portfolio. The other side of it is that people might be picking up stocks that are down, really down right now, seeing that this is an opportunity to buy more and to do some dollar cost averaging. And so a couple of things happen, for some people who are optimistic and some who are feeling very downtrodden and pessimistic. It's two different experiences happening today.
And what about for people who say, well, I'm not into trading, but what impact is it going to have on, anyone who has an RSP or a TFSA?
So if you're not into trading, today's just another day. Trading is for those people who are in and out of the market on a daily, weekly basis. And I have always been of the mind that we should not be traders. We should be investors. And trading is very much like gambling. You're trying to forecast. You're trying to, see the short term. I always am long term. I'm always long term horizon. Things that are going to be happening in 5, 10, 15, 20 years time rather than 2, 3 days time. If you're someone who's trying to time the market or trying to figure out what stock's going to do well in the next few months, that's not the way that I would recommend. If you have, if you're thinking of long-term growth, that's not the way that I would recommend that you use your money. This should just be another indication of market volatility. Really go into a chart. So example, using that S&P 500 as an example, go into that chart and zoom right out 20 years to see how the markets have reacted during times like the 2008-2009 financial crisis, during the beginning of the pandemic. These were other very volatile times in the market, and you'll see how they recovered and how staying in the market is usually much more beneficial than trying to get in and out.